Welcome to the first of many videos. This is going to be a long series. If you don't know who I am, my name is Aiden Hamlin. I have over 7 years of experience investing into stocks, cryptocurrency, and bonds. And I have averaged roughly 180% plus in the year 2023 and 2024. This was not by pure luck. It took a lot of losses. It took a lot of learning. But if you just pay attention, I can show you exactly what I did to get there faster. Now, here's the thing with investing. It takes a certain person if you're trying to get out of the rat race, ideally in 7 to 10 years. It takes anywhere from $900 to $1,000 a month to get to 100K in 7 years. Most people don't do it though because it requires a certain level of discipline that most people do not have. Bitcoin at one point was 16,000 and you did nothing. It was 22,000 and you did nothing. It was 24,000 and you still did nothing. Now you're picking up double shifts and you're working extra hours and you're looking for a better job. Now that Bitcoin is 110,000 and you're trying to buy it. It doesn't make sense. You did this to yourself, but luckily for you, you're watching this video. Welcome to the Learning Hub, and here we go. First thing is first, rich people get rich from taking your money when investing in stocks. So what happens a lot with people is they'll invest, let's say I bought right here, and then this big crash comes down, and I say, okay, well, you know what, I'm gonna sell all of my money. I'm going to sell all of my stocks so I could save my money. And then they miss this entire recovery back up. And you know who bought your stocks when you sold them? It was JP Morgan Chase. It was Fidelity. It was BlackRock. It was all of these big companies buying back your shares when everybody else was scared. So something to keep in mind when investing in stocks is that nothing in life that is good comes at a guaranteed 100%, no risk at all attached. There's no light without dark. There's no joy without pain. You can't have a little bit of sunshine without a little bit of rain. So when you look at the stock market as an investor, it looks really scary at first, but instead of buying NVIDIA or AMD because you heard that they're going up super high, instead focusing on indexes or indices such as SPY, QQQ, SCHD, VTI are all very good ETFs that gives you a broad ownership of the general stock market. VTI is the general stock market, the S&P 500 or SPY. That is a culmination of the top 500 companies performance-wise inside of the New York Stock Exchange. Something else to keep in mind now is that there's no holy grail when investing. There's a lot of different strategies out there. There's a lot of different gurus out there selling you their $10,000 a year course. It just boils down to, do you have time in the market? Don't try and time the best opportunity to get into the market, but focus on getting more time in the market. If you miss the best 60 days of the S&P 500, if you don't invest on those days, you take the amount of money that you could have potentially earned and reduce it to anywhere from 40 to 60% of its value. Just by missing out on 60 of the best days, the S&P 500 each year, you would have missed out on 40 to 60% extra profits. So getting in every single day is super important. Best way to do that is to automate your portfolio, whether it's Webull, Fidelity, to take money out of your bank account automatically. It's very easy to set up. A monkey could do it. Now, moving into how you can make more money investing if you already are investing. There's something called risk management, and a lot of people don't look into it enough. The best investors that I've spoken to don't focus on making the most profits. They focus on having the least losses. Making 3 to 4 good decisions a year is a soundproof idea so long as you stick to your plan. if you have a really good 5-year plan, but year 2 is where it sucks the most and you leave, you're missing out on years 3, 4, and 5 where you could have had an insane amount of potential, an insane amount of growth, especially when you had the 2022 dip. When 2022 it came crashing down, a lot of people sold instead of doubling down, buying back in, because they didn't have extra capital to expend. Which gets into the basic questions of, well, when I invest, how much money should I put in? Should I put all of my money in at one time? When do I know when to sell? How do I know when to sell my stocks so that I avoid losing a lot of money? These are all very common questions, and to answer them briefly, looking at probability is the best way to go about reducing your risk. So you have something called a Kelly fraction, and a Kelly fraction is just a fancy way of saying, well, how much money should I put in each time given the amount that I'm expected to return? So if I'm expecting the S&P 500 to go up 10% in the next 7 months, how much money should I put into it every day, assuming its probability of success? So what we can do to dumb this down, let's make this a little bit simpler. Okay? So let's say that I would like to enter into an investment for $1,000 into ABC Company. Okay? Now, the thing with ABC Company is they have something called volatility. Now, the problem with volatility is the higher it is, the riskier. So going back to our Kelly fraction, okay? If we look at the Kelly fraction, you can see variance right here. That is accounting for certain volatility when moving. So keep that in your brain. Now, I want to invest in ABC Company. I really do. But I don't want to put all of my 1,000 in there right now. So let's assume I want to put $1,000 in, and the probability of me making money from ABC Company going up is 75%. And my expected return is 1.5. Now, 1.5 represents a 150% return. That means that my probability of losing is 0.25. Now, this is for the Kelly fraction. And this fraction is going to essentially be used to determine how much invested. And I'm going to divide that by my return. Now, what you'll find, okay, is that, well, 1.5 times 0.75 is really just, let me do the math in my head here. Let's think about this. Half of 7.5 is 3.75? 375, so terrible at mental math, I'll tell you that much. Let's see. So 1.5 times 0.75 minus 0.25. So you have 0.875 in the numerator and 1.5 in the denominator. So all that's telling us then, in theory, where does that calculator keep going? In theory, what that is telling us is that if that is the case, I should put 0.58 of my money into ABC company. On each investing period. So that would be $580 of my money into ABC company. Now, the thing is, that's an extreme example. The reason why it's 58% is because the probability is so uneven and your return is 150%. Typically, a return is not going to be 150%. So let's do it with a more realistic example. Okay? Let's say the probability of the move is closer to 0.63%. So the probability of me not making money is 3.7. And the return on my investment would be 25%. Now, what's going to end up happening is you're going to have let's just do this really quickly here. Hold on. Let's see this. This is 0.63 over 4. And if we were to do this out or do the math out, 0.63 over 4 is not bigger than 0.37. So 0.63 over 4 is really really 0.1575 minus 0.37 over 0.25. And then you have a negative Kelly fraction. So does a negative Kelly fraction mean that I'm going to lose money or that the probability of me losing money is high? No. What happens when you have a negative Kelly fraction is you can now, in theory, take the Kelly fraction of each day that you're calculating the Kelly fraction, because this is destined to change. This is why I said to focus on ETFs and indices, because their probability metrics are more likely to go through, because when you have a particular individual company, it's too idiosyncratic where you have the CEOs in a scandal at the Coldplay concert and you don't want to deal with it. There's too much external factors. Now, if I were to graph this out, let's say that my starting point is right here, okay? Now, the thing is, if my Kelly fraction is increasing over time, that means that I am now in a bullish environment. Now, this is, of course, theory. When put into actual practice, this is a indicator, but not a set rule. What that means is that, hey, yeah, this is a good estimate, but there's no real saying of what could happen. If you ever watched The Wolf of Wall Street, Matthew McConaughey's guy, he's the one saying, you know, numbers, they go up, down, left, right, you don't know where they're going to go. Which is partially true and not true. Using these probability metrics, we can have a better understanding exactly of where stock price is heading and how much money we should be putting in on each of these transactions. So now, what happens when I have a negative Kelly fraction and I currently have exposure to the stock. Well, all that means is essentially right now is not a moment where you would do anything. Essentially, what it means is you would stick to your plan of daily investments and just making sure that you have a stop loss and a take profit. It's quite simple. Then, when you have clear probability, 1, 2, 3, 4, hey, where do I think this guy is about to go? Probability of this particular move going up, probability of this going up is much higher than the probability of this going down, given historical data. But real life things such as COVID, such as Russia and Ukraine, can have an impact, obviously, on the movement of these ETFs and these tickers, which is why, again, I keep emphasizing the importance that you do this with indices and not individual companies. You will not get the same results. When you have a Kelly fraction on a particular stock, there are other factors that you have to account for, and you have mathematicians who are working day and night still trying to figure out that sweet spot, but all that they can really do is use basic sector data to determine, what is the average Kelly fraction and average Sharpe ratio, average variance and standard deviation of stocks like Tesla, of stocks like Apple. And they can use these metrics to make a comparison and say, well, based on the broad market of this stock, let's say you have a stock such as, trying to think of something that has a lot of competitors. Let's say Nvidia. Let's say Nvidia's Kelly fraction right now is 0.12, and AMD's Kelly fraction right now is a 0.01. What that signifies to us is that, well, okay, what is the average of the semiconductor industry or sector? And whatever that average is, whichever is closer to that average, that is the one that is probably going to see more success in the future. Now, I hope this makes sense. If you can apply this to different probability metrics, there's fun ways that you could do it too. You can use this in roulette to increase your probability. And of course, remember to just take your emotions out of the investing aspect of it. Whatever you put into the stock market, you essentially have to be comfortable with losing anywhere from 10 to 25% of it. That is if you put a stop loss in place, which is the other part of risk management. If you are buying a stock, ETF, indice, whatever the case, you should always have some type of stop loss set into place. A stop loss is essentially you saying, if the price goes down to this level right here, sell. That's a stop loss. Take profit is the opposite of that. If the stock hits this price, sell it. Reason most investors do that is because, hey, I made my profits, I just want to protect them now. That's a really good strategy that some people use to reduce the amount of exposure they have to one particular company. And I personally do every 3 to 6 months. Now, if you learned something from this video, like, follow, subscribe, hit the notification bell. And if you have any questions, leave them down in the comment section. The next video will be coming very shortly.